Picture yourself strolling to your letterbox on a perfectly ordinary afternoon, sifting through supermarket leaflets and utility statements when you notice an official communication from the IRS. A slight knot forms in your gut. You tear it open, anticipating perhaps a standard notification. Instead, you are confronted with a financial penalty, totaling $10,000. And the most perplexing aspect, you possess absolutely no inkling of any wrongdoing. You did not conceal wealth abroad. You did not operate a clandestine business. You did not evade your fiscal obligations. All you did was place some currency from the sale of your vehicle. Or perhaps your daughter provided you funds to assist with medical expenses, or you transferred assets to finally substitute that aging roofing. Entirely typical retirement activities. However, in 2026, conventional does not invariably equate to secure. For what is instigating these assessments is not illicit conduct, it is consistent indicators. Indicators highlighted by automated mechanisms that are unaware of your personal narrative. And once that mechanism determines something appears suspicious, the financial consequence can commence at $10,000 for a singular infringement. Today, we will thoroughly examine precisely what is transpiring, why so many retired individuals are encountering this unexpectedly, and the one straightforward misstep that can transform an innocent banking visit into a federal complication. Greetings, I am Jessica, and I dedicate my efforts to assisting retirees in safeguarding the accumulated savings they labored a lifetime to construct. And I must discuss with you an element that has subtly shifted within the financial landscape this year. The regulation itself is not novel. In truth, it has existed for numerous decades. Yet, the manner in which it is being applied in 2026 is fundamentally distinct, swifter, automated, and considerably less forgiving when elements do not perfectly correspond. My objective today is not to cause apprehension. It is to ensure your comprehension of the true situation, what form of routine banking transaction can initiate a substantial penalty, and crucially, how to safeguard yourself so you never encounter that $10,000 unforeseen charge. Because once you grasp its operation, you will recognize the hazard is not readily apparent. And that is precisely why we must engage in this discussion. So, let us begin with the aspect that is catching individuals entirely unprepared. The everyday financial activities that appear utterly benign on the surface. Visualize this. You dispose of your seasoned pickup truck for $15,000 in physical money. The purchaser arrives, counts it precisely, and you proceed to the financial institution to deposit it. Straightforward. Or perhaps your son electronically transfers you $20,000 to aid in covering some unforeseen medical expenditures. Or you finally accept that lump sum pension disbursement you have contemplated for years. Or you shift a substantial portion of savings from one financial holding to another because you are making a down payment on a recreational vehicle. None of that is illicit. None of that is questionable. It is simply life. It is retirement. It is your financial assets. However, this is where circumstances begin to diverge in 2026. Financial institutions are not merely retaining your deposits. They are documenting specific categories of activity automatically, and those records do not reside in a physical repository somewhere accumulating dust. They are being scanned, categorized, and cross-referenced by mechanisms designed to detect discrepancies. Therefore, when a significant amount of physical money abruptly materializes in your financial account, the mechanism does not perceive truck sale or gift from offspring or retirement payment. It perceives numerical values, it perceives indicators. And if those indicators do not harmonize with what is present on your tax declaration or other financial documentation, it signals a digital inquiry. This is the aspect that feels unjust to many retired individuals because from your vantage point, you are merely managing your financial affairs responsibly. But from the mechanism's vantage point, it is posing one highly specific query. From what origin did these funds materialize, and were they appropriately declared? And if the response is not perfectly transparent within the data it possesses access to, that is when complications can commence. Now, here is the surprising element that astonishes nearly everyone. The foundational regulation behind all of this is not innovative, not even remotely. In fact, it has existed for numerous decades. What has evolved is the intensity and the efficiency with which it is being administered. Central to this is an item referred to as a currency transaction report, or CTR. And despite how intimidating that designation sounds, it is actually quite uncomplicated. By legal mandate, financial institutions are obligated to submit a CTR whenever an individual conducts a physical currency transaction exceeding $10,000. This encompasses physical money deposits, physical money withdrawals, even certain forms of transfers. Consequently, if you enter your financial institution and deposit $12,000 in physical money, the institution completes a document and dispatches it to the governmental authority. You do not complete it. You do not even necessarily observe it. It occurs discreetly. And here is the vital point. A CTR is not a punitive measure. It is not an accusation. It is not an indication of error on your part. Millions of these declarations are filed annually. For decades, this has been standard practice. Business proprietors deposit physical money. Individuals dispose of vehicles. Households relocate funds, the institution submits the document, and existence proceeds. Therefore, if that has constituted the legal framework for years, why are retired individuals suddenly learning about $10,000 assessments? Because historically, these declarations largely remained dormant unless a human investigator possessed a justification to scrutinize further. Presently, that is no longer the circumstance. Now, those CTRs are instantaneously processed into automated mechanisms that juxtapose them against tax declarations, social security records, pension disbursements, and other financial data. The mechanism is no longer solely gathering information. It is scrutinizing it in real time. And when it discovers a discrepancy, that is when difficulties emerge. But there is an additional layer to this, one that is even more precarious than a straightforward large deposit. It is an error that well-intentioned persons frequently commit, believing they are in fact exercising astuteness. And in the estimation of the IRS, that singular choice can transform an entirely lawful transaction into a federal infraction. That is our next topic of exploration. This is where everything changes and where many upright, law-abiding retired individuals inadvertently venture into hazardous territory. Let us assume you possess $12,000 in physical money. Perhaps it originated from the sale of a vessel, perhaps it constitutes savings you kept at home, perhaps it is funds you have held for years and simply never deposited. You enter the financial institution and just before you approach the teller, a small internal voice suggests, "If I deposit all of this simultaneously, they will report it. I wish to avoid any superfluous attention." So instead, you deposit $8,000 on Monday, then you return on Wednesday and deposit the remaining $4,000. From your vantage point, that feels innocuous, responsible even. You are not concealing earnings. You are not evading taxes. You simply desire to avoid official documentation being filed with the government. That seems rational, correct? But under federal statutes, that choice can fundamentally alter the situation. This phenomenon is termed structuring. Structuring occurs when an individual deliberately divides a substantial physical currency transaction into smaller amounts for the explicit purpose of circumventing that $10,000 reporting mandate. And here is the aspect that catches individuals off guard. The funds themselves do not need to be illicit. It is irrelevant if they originated from your pension, the disposition of personal assets, or a monetary gift from relatives. If the deposits are separated specifically to prevent the initiation of a currency transaction report, that action alone can be deemed a federal violation. And yes, financial penalties for structuring can commence at $10,000 per offense. Now let us draw a clear distinction because this is paramount. If you enter the financial institution and deposit $12,000 in physical money in one single transaction, the institution files a CTR. That is the extent of it. A routine procedure, legally compliant, no offense, no punitive measure. In the vast majority of instances, nothing further transpires. But if you deliberately deposit $8,000 and subsequently $4,000 specifically to circumvent that report, you have just established a pattern that automated mechanisms are designed to detect, and those mechanisms are highly adept at discerning patterns. They analyze temporal aspects, They scrutinize monetary values. They examine sequences of transactions over periods of days or weeks. If it appears the deposits were arranged to remain beneath the reporting threshold, that is when cautionary indicators rapidly intensify. And here's the inconvenient reality. The mechanism does not perceive your thoughts. It does not comprehend you were merely attempting to avoid additional scrutiny. It only registers the pattern, and the pattern holds significance. This is where numerous upright individuals encounter difficulties. They believe they are exercising caution. They believe they are remaining unnoticed by some imagined surveillance. But in actuality, disaggregating deposits to prevent reporting is precisely what brings them to notice. Allow me to express this with utmost clarity. The submission of a currency transaction report is not problematic. Endeavoring to circumvent one can be, and this constitutes the transformation occurring in 2026. With sophisticated automation, cross-referencing, and real-time analytical capabilities, these patterns are no longer eluding detection. The mechanism does not necessitate a human investigator situated at a workstation. It identifies discrepancies instantaneously. It correlates deposits with tax declarations. It contrasts declared income with physical money activities. And when something does not correspond, notifications are dispatched automatically. Now, before you allow this to escalate into apprehension, take a moment to compose yourself. The IRS is not targeting retired individuals who are merely managing customary financial affairs. The overwhelming majority of persons who deposit funds appropriately, even substantial sums, never encounter an issue. The genuine hazard lies in misinterpreting the regulation. So, here is the primary crucial insight. Never disaggregate a transaction solely to remain beneath $10,000. If you possess legitimate physical money exceeding $10,000, deposit it in a single transaction. Permit the financial institution to submit the necessary report. That is what the mechanism anticipates. That is what maintains all processes in order. If this is already assisting in clarifying matters for you, please take a brief moment to like this presentation and subscribe. I share updates such as this specifically to aid retired individuals in circumventing costly errors before they materialize rather than subsequently. Because now that you comprehend structuring, we must discuss something equally important: how to safeguard yourself moving forward. What straightforward practices can ensure that even in this fully automated IRS operational setting, you are never caught striving to explain your own financial resources? That is precisely our next topic. Now that you grasp the genuine area of risk, let us transition from mere cognizance to active safeguarding. For this is not about panic, it is about foresight. The enforcement environment in 2026 may be more automated, swifter, and less tolerant of inconsistencies, but the method by which you shield yourself is surprisingly uncomplicated. It does not necessitate intricate legal strategies or expensive evasions. It requires meticulous arrangement, unequivocal clarity, and a verifiable record. So, here is the initial step, and candidly, this is the most potent one. Maintain comprehensive records. Whenever a substantial sum of money moves into or out of your financial holdings, you desire documentation that unambiguously explains its origin. If you dispose of your automobile for $15,000, retain a signed receipt of sale. Produce a duplicate, digitally capture it, store it in a secure location. If your offspring provides you $20,000 to assist with medical expenditures, request them to draft a concise letter of gift, stating the amount and confirming it is a gift, not income or a loan. If you receive a lump sum pension payout, preserve the distribution paperwork. If you extract physical money for a significant acquisition, retain bills and receipts. The objective is straightforward. If anyone ever inquires, you can instantaneously present the genesis and intent of the funds. Because here is what most retired individuals fail to grasp. The IRS computing system does not automatically comprehend the context of your transactions. It processes numerical values. Your documentation furnishes the narrative supporting those numerical values. And when the narrative is lucid and substantiated by paperwork, complications tend to dissipate rapidly. Step 2. If your financial existence is more intricate than merely Social Security and a modest pension, this is the opportune year to consult with a qualified fiscal expert. A proficient CPA does not merely complete forms. They assist in ensuring your tax declaration conveys a complete and coherent account. If you had a substantial deposit from the disposition of property, that must correspond with what is declared. If you acquired a considerable gift, they can assist in ensuring all is documented correctly. Automation highlights disparities. A fiscal expert aids in preventing them before they materialize. And step 3, engage in open communication with your financial institution. This often surprises individuals. There is no detriment in inquiring with your bank about their reporting protocols. In fact, transparency operates to your advantage. If you are contemplating depositing a substantial sum of legitimate physical money, you can simply execute it correctly and permit them to submit the mandated report. Recall, a currency transaction report is standard procedure. It is not an allegation. Attempting to circumvent it is what generates exposure. When you integrate these 3 practices, thorough documentation, expert guidance when appropriate, and openness, you significantly diminish your prospects of ever encountering that $10,000 unforeseen charge. Let us pause for a moment and consider this in broader terms. The automated systems in 2026 are highly effective. Indeed, they connect points instantaneously. They cross-reference deposits with tax filings. They discern patterns that human observers might overlook. However, they remain data-driven mechanisms. They depend on consistency. When your records are meticulously organized and your transactions are unambiguous, you are functioning precisely as the system anticipates. This is not about concealment. It is about explicit clarity. And if you know another retired individual, perhaps a companion, a family member, someone within your community who still believes dividing deposits is a clever tactic, share this information with them. A simple misunderstanding could incur costs of $10,000 or greater for someone, because the reality is the financial world has transformed. The conventional approach of conducting affairs where minor inconsistencies might escape notice is rapidly diminishing. We are now residing in a fully digital enforcement period. And the individuals who prosper in this novel environment are the ones who circumvent unnecessary strain, which leads us to the broader implication. Here is the larger perspective you must grasp. The enforcement paradigm shift we are observing in 2026 is not transient. It is not an experimental initiative. It is not something that will vanish next year. Automation is now intrinsically woven into the fabric of financial oversight. The systems are swifter, they are more interconnected, and they are engineered to function continuously in the background. That implies the retired individuals who face the greatest exposure are not those engaged in any illicit actions. They are the ones operating under outdated presumptions. For many years, numerous individuals believed that if something did not immediately provoke concern at the financial institution, it was likely inconsequential. If you maintained small deposits, remained inconspicuous, or managed matters discreetly, you were being prudent. But in the current environment, endeavoring to remain inconspicuous is precisely what generates a discernible signature. That is the paradox. One direct $15,000 deposit accompanied by appropriate documentation. Customary, recorded, processed, subsequently unremembered, multiple smaller deposits made deliberately to avoid reporting. Pattern identified, flag activated, inquiries generated. The system is devoid of sentiment. It does not presuppose culpability, but it does presume that patterns intended to circumvent reporting warrant meticulous examination. And once that examination commences, it can be demanding, time-consuming, and costly to resolve. Now, I wish to provide reassurance. Most retired individuals viewing this will never incur a structuring penalty. Most substantial deposits, when executed correctly and supported by records, proceed through the system without incident. The objective here is not to instill apprehension every time you enter a financial institution. The objective is to substitute ambiguity with distinctness, because distinctness influences your actions. When you comprehend that a currency transaction report is normal, you cease to dread it. When you grasp that structuring pertains to the intention to circumvent reporting, you cease inadvertently creating hazardous patterns. When you comprehend that documentation articulates your financial narrative, you begin maintaining the type of records that automatically safeguard you. This is fundamentally about perspective. The former perspective was to maintain discretion. The new perspective must be to maintain documentation. That singular alteration can spare you immense pressure. So here is the question I urge you to ponder profoundly. If a comprehensively digital IRS mechanism scrutinized your past 12 months of financial activities, would the narrative appear logical on paper? Would every substantial deposit possess a clear elucidation? Would every transfer of funds correspond with what is declared on your tax return? If the response is affirmative, you are functioning precisely where you ought to be. If the response is uncertainty, then now is the ideal juncture to systematize, to meticulously arrange paperwork, to digitally capture documents, to consult with a fiscal expert if necessary, and to rectify anything that feels obscure. Not because you are in difficulty, but because proactive preparation is considerably more economical than punitive assessments. You toiled for decades to build your retirement savings. You made sacrifices. You planned diligently. You made judicious decisions so you could relish this phase of life with assurance and tranquility. The last outcome you desire is a preventable $10,000 penalty owing to a misapprehension regarding the mechanics of financial institution reporting. The regulations themselves have not drastically transformed. What has changed is the velocity, the visibility, and the automation underpinning enforcement. And the retired individuals who prosper in this novel environment are not those who succumb to alarm. They are those who adapt. Therefore, deposit substantial amounts appropriately. Never divide transactions to evade reporting. Preserve documentation for significant financial occurrences. Ensure your tax return accurately mirrors your reality. And regard transparency as a form of protection, not a vulnerability. Because when your financial paper trail is explicit, methodical, and uniform, automated mechanisms have no grounds for inquiry. And that is where peace of mind resides.